Losing a spouse changes everything. And in those first few weeks, it can feel like you've been handed a second full-time job. Executor, bill payer, decision maker, all while you're just trying to breathe again. Here's the truth. You don't have to solve everything at once. What matters is knowing what to handle now and what can safely wait, and which decisions could quietly cost you later if you don't plan them right. The biggest financial risk after losing a spouse isn't making a bad investment, it's making rushed decisions in the fog of grief. Most people feel pressure to get things in order fast, but what in order really means depends on timing, and timing matters for taxes, estate work, and peace of mind. So let's walk through this together. We'll cover what to do immediately, what to handle within the first year, and what to update once the estate settles. And along the way, I'll point out the key deadlines that can make a real difference financially. First things first, focus on stability, not optimization. Make sure bills are covered and cash flow continues. Social Security will stop your spouse's payment, but you'll likely qualify for the survivor benefit, the higher of the two checks. That doesn't happen automatically, so contact the Social Security office to file. If there's life insurance or joint accounts, use those for current expenses. Try not to make any big investment or home decisions until you're clear on what your cash flow looks like day to day. Once you know what's steady, what's truly supporting you, then you can decide what comes next from a place of confidence, not reaction. That clarity also helps you compare options. What does cash flow look like if you stay where you are versus if you sell and downsize? Sometimes freeing up home equity can ease pressure. The key is understanding what those numbers mean for your lifestyle before making a move. Grief clouds judgment, and most financial changes don't need to happen this month. Think of this phase as the protect and pause. When things start to settle, when paperwork slows down and life finds its new rhythm, that's when the real planning begins. The first year is where the most important opportunities and risks start to show up. Phase 2 is the first year window, which is taxes and timing. So let's start with what's called the widow's tax trap. For the year your spouse passes, you can still file jointly. That 1 year window can open doors for Roth conversions, capital gain harvesting, or realizing income at lower rates. After that, you'll file as single and your tax bracket jumps. Here's a simple example. Imagine a couple, Tom and Linda, with about $90,000 of taxable income. As a married couple, that keeps them in roughly the 12% federal tax bracket. The next year after Tom passes, Linda's income barely changes, maybe $80,000 after her survivor Social Security benefit. But now she's filing single, and the 12% bracket ends around $47,000. Everything above that gets pushed into the 22% bracket. Her top rate goes up, and even though taxes are graduated, her effective rate still climbs several percentage points. Same lifestyle, same income, yet a couple thousand more in taxes, which can feel like hundreds missing from each monthly paycheck. That's the widow's tax trap. Phase 3 is the home sale window. Another big opportunity or surprise comes with the home sale window. If you decide to sell your home, there are two tax rules that work together. and they can make a big difference in how much you keep. When a spouse passes, the surviving spouse often receives what's called a step up in cost basis. That means the purchase price for tax purposes resets to the fair market value on the date of death. Here's where state law really matters. In community property states like California, Texas, Arizona, Idaho, Washington, Nevada, Louisiana, Wisconsin, and New Mexico, the entire property usually receives a full step up in basis. So if you bought your home for $200,000 and it's worth $700,000, when they pass, your new cost basis becomes $700,000. If you sell it for that, there's virtually no taxable gain. In the rest of the country, most other states, only your spouse's half typically gets the step up. So same example, you bought the home for $200,000, each owned $100,000. When your spouse passes, their half gets stepped up to $350,000, half of the $700,000. Together, your new total cost basis is $450,000. If you sell for $700,000, your taxable gain is $250,000. Now layer in the home sale exclusion rule. If you sell within 2 years of your spouse's passing, you can still exclude up to $500,000 of capital gain. The same as when you were married. After 2 years, that exclusion drops to $250,000. So even with that $250,000 gain, if you sell within 2 years, you'd likely owe no capital gains tax at all. That's why timing and understanding your state's rules matter so much. Before making any decision to sell, talk with your CPA or advisor. One conversation can save you thousands in unnecessary taxes. Phase 4 is legal and estate details. Let's talk about the legal side. If your spouse had a will, it usually needs to go through probate. That's the court process that validates the will and transfers assets. If there was a trust, that typically avoids probate, which means faster access and less cost. Either way, it takes time, sometimes weeks, sometimes months. If you're unsure where to start, call your local probate court or clerk's office. They can walk you through what forms you'll need and help you avoid delays. Once the estate begins to wrap up, that's the time to update your own legal documents, your will, healthcare directive, and financial power of attorney. This isn't about expecting the worst. It's about protecting your peace of mind. Phase 5 is building your new plan. After the estate is complete, you'll finally have a clear picture of what's truly yours, your income, investments, home, and benefits. That's when it's time to create your new plan. Start with 3 steps. Inventory everything now under your name. Define what you want this next chapter to look like. Design your cash flow so you can live fully without fear of running out. You're not starting over, you're stabilizing what you've already built. If you're walking through this season or you simply want to be prepared, connect with a financial planner and your CPA. They can help you prioritize what's urgent, what can wait, and how to use that 1-year joint filing window wisely. Remember, you don't have to fix everything this year. You only have to protect tomorrow, because peace doesn't come from quick action. It comes from knowing you're steady even when life isn't.